Next week, Delta, JP Morgan, and the Fed will all be in the news. Let's talk about why. Welcome back, everybody. Don Miller here from MarketBeat. I got back with me this week, Thomas Hughes. We're going to do a little preview of the upcoming week, what went on this week. Thomas, how you doing today?
I'm doing good, Don. How are you today?
Always good. Hey, the jobs report came out today. Still hot, probably not as hot as most people expected, but enough to probably get the Fed back involved in what's going to go on with the market, at least in the short term, in the near term, coming up in the next couple of weeks. What can you tell me about that?
Yeah, the jobs report, the labor data in general is pretty bullish, I'd say, for the economy. The non-farms payroll number was tepid relative to the analyst expectations, and it has kind of been trending lower, but it's still trending above the levels it was before the pandemic. So the labor market's still quite strong. And the ADP figure was double expectations. Now, those two numbers don't always track together in sync on a month-to-month basis, but over time they do track in sync, and together, even with downward revisions to previous months, are showing a healthy, resilient labor market. And that doesn't really give the Fed any room to pause. If inflation remains high, they don't need to worry about trying to save the labor market right now because it's still pretty strong. That said, there are also some signs of weakness and some shifting in the labor market that everybody needs to watch out for. And that's primarily seen in the Challenger, Gray, and Christmas report on layoffs and hirings. Now, again, layoffs fell 50% on a month-to-month basis. That's awesome news. Layoffs fell, but layoffs are up. If I find my number here somewhere, they're up 25% year over year, 245% year to date. And hiring is also at a multi-decade low. So layoffs are high, hiring plans are low. The future outlook of the labor market is questionable because of those numbers.
Thomas, the Fed has a mandate to take care of two things: unemployment and a stable money supply, if you will. But there's something in the background percolating, and you know me well enough to know that I was going to touch on this today, and that's oil prices.
Right.
I think and have thought, and you know this again, after talking to me for so many years, that oil prices generally drive a lot of our economy. We use more oil than anybody out there. But OPEC has decided oil prices are probably a little bit too low for them. And so they're now looking for new members. And I've said this out loud, and I'll say it again, they're not going to let oil prices stay where they are, but that doesn't bode well for inflation for us, correct?
Well, right. Inflation was caused by a few things that kind of played together, and oil prices were certainly one of them. Oil is the leading input cost for everything from your gas to get to work to the lubrication and plastics that are in the machinery that you use to work. We can't get away from oil. It's not going away. Oil prices have fallen quite substantially from their high, but you got to remember that they've stabilized at levels not seen in like over a decade, right? So before the pandemic, oil topped out at levels where it is now, and now it's bottoming out at those levels. In that environment, we've got OPEC. They're trimming or cutting back on their production levels. They've got their production cut just enough to offset completely the demand increase. So the supply demand increase is in favor of higher prices. And now, like you say, they're looking for another member. They get some more members, and their Secretary General had said that there are several countries that fit the bill as far as being aligned with OPEC's needs and goals. They get some more members, their market share goes from 30% to 40% or more. They have even more control of the market. So I think that the price of oil is pretty well supported at the level that it is. The bias is certainly tilted upwards. Mm-hmm. Inflation will have a hard time coming down without oil prices falling. Oil prices are set to rise, and I think that's going to drive inflation some more.
100%. I agree with you 100%.
All
right. We have some people out there talking about a recession or the odds of a recession. You've been on that bandwagon, I know, for this entire year. But all these things continue to point to a recession, yet it may not get as much media play as it should. Let's call this right now. Are you going to say that we're definitely in a recession, maybe in a recession, or definitely headed that direction?
Well, I think that we're in a technical recession now because of the leading indicators. Leading indicators have been negative and trending lower for almost a year and a half. I mean, that's recessionary. All the indications are pointing to recession. The yield curve just hit its widest level in like 40 years, I think, is the number that they said this morning. So I think recession is looming. And a thought that I've had, if you can kind of imagine this, the economy got wound up on stimulus and inflation. All right. Now imagine the fire truck. They had that siren that winds up really, and it slowly, slowly, slowly winds down. You know it's going to stop soon, but it's hard to tell when it's going to stop. And right now the economy is winding down to that point, and there was so much inflationary momentum. It just kind of keeps on going, but soon that momentum is going to stop and it's going to pull back. And it looks like it's going to happen. I mean, we've been on the brink of it for quite a long time. It looks like it's closer than ever. Some things that we talked about point to it. Levi's earnings report this week suggests that consumer spending will weaken this summer and in the second half. Rising interest rates are going to cut into mortgage demand. That's going to cut into home sales. That's going to lead to a recession. We've already talked before about how the home builders, they're being supported by this demand. That demand is artificial because you can't buy any existing homes, but they're still facing an earnings and a revenue cliff that's going to happen. It's happening now. It's hard. It's hard to not think that there's going to be a recession. The question is how deep it's going to be, how long it lasts, and where we go from there.
By the way, that was an elite level analogy there. I appreciate that. I know our viewers are going to understand that as well.
Okay.
It made me smile on the inside. I loved it.
All
Hey,
right.
you spoke briefly about earnings, and that's where we are with this week's report. As we said earlier, the Fed's going to get back involved in things now with the data that they got coming in. But there's one company that I'd like to focus on a little bit, and I'll tell you why. Delta Airlines has been on the rise of late, along with a couple of other airlines. I flew last week to Sioux Falls, as a matter of fact, and flew on 4 Delta jets that were packed to the gills, each one of them. That's a good sign for them. What can you tell me about earnings? And would you, let me ask you this. I know I don't want to put you on the spot here because that's not what we do. However, would you say that running into earnings that Delta would be a buy? Or to play the earnings, I should say.
Delta looks like a buy right now. They called it guidance. They put out some guidance a week or so ago. It was really like a pre-release. The guidance was very strong, supported by industry gains, but also by company gains. They're working on efficiency, building up their fleet again. They've been the leading carrier for a long time. They're still the leading carrier. The chart looks fantastic. I think the chart is a bull flag. I think going into earnings, it's a very good opportunity. The only risk really would be is if they come out with something in the earnings report or the guidance that somehow contradicts what they said a few weeks ago, and I don't see that happening.
No, and like I said, judging by Delta flights that I was on last week, I can't see that happening either. By the way, Delta is my favorite airline as well.
All right.
Hey, what else on the earnings calendar next week that you got your eye on that might be important for our viewers to pay attention to?
That was my list. Earnings calendar. Well, it's the start of earnings season, and let's just say, yay, earnings season started again. Things to do and things to write about. WD-40 Company could be a good one. They're reporting on Monday. They've been working on global expansion, internal efficiencies, input costs might have come down. They're expected to post a substantial increase in top and bottom line revenue to begin with. They could produce an earnings surprise. That'd be fantastic. That chart looks good as well. Looks like a head and shoulders. It's approaching the neckline. We get a good report. It could break out to the upside. JP Morgan on Friday. Earnings season really starts on Friday with the banks. I highlight JP Morgan because it's the world's largest bank outside of China. It can be used as a proxy for all the other banks. If you want to know how the other banks are doing, get a grip on what their core business is and look at that part of JP Morgan's bank business, and you'll have a good idea what's going on. But again, expected to post a significant, substantial increase in revenue and earnings driven by NII, which means interest rates. Interest rates are driving their margins. What we're going to be looking for here is the outlook for interest rates and NII, which is going to be good. Rates are still going up, but we also want to see what they say about the consumer health, and the economy at large, because right now we're in a condition and situation where conditions are good for the banks. Rates are high, but that's not so good for everybody else. And I expect that we'll probably see some signs of that within the reports.
Thomas, thank you for being here today, and thank you for bringing it today. A lot of information there, folks. If you want to get the newsletter that Thomas writes for MarketBeat emailed to you, there's going to be a link down in the description. You can try that out free of charge. It's an in-depth report, usually 2,500 to 3,000 words of really good information. And by the way, we also drop this video every Sunday afternoon at 4 p.m. If you'd like to get notified for that, you know how to click the notification bell, subscribe, and give us a thumbs up if it's doing you any good and you'd like to see more of these kind of things. Thomas, thanks for being here. But until then,
remember the trend. And I just want to tell everybody, if there's something that you want me to write about, let me know down in the comments and I'll try to work it in.
Wow. There you go. Thanks, folks.